The Value Investors. Lessons from the World's Top Fund Managers. By Ronald Chon and Bruce C. Greenwald. Audiobook presented by the Learner's Library. Chapter 10, Value Investing in the Lost Decade. A musical beginning. B. Breaking the language barrier. C. Learning from the West. D. The evolution of SPARX. D. Building a Westernized Asia. E. Searching for value. Chapter 11, Eternal Sunshine of the Value Mind. A multidisciplinary path. B. Seeking a comfortable price. C. Finding a value partner. D. Spotting value minds. E. Becoming a man of value. Chapter 12, The Accidental Value Investor. A. Starting an investment hobby shop. B. Building a value temple. C. An industrialized process. D. A value march forward. Chapter 13, The Making of a Value Investor. A. Humble portfolio construction. B. The art of valuation. C. Reading for ideas. D. More than just the fundamentals. E. Timing for an exit. F. Having the right temperament. Chapter 10. Value Investing in the Lost Decade. Shuhei Abe. SPARX Group. In the struggle for survival, the fittest win out at the expense of their rivals because they succeed in adapting themselves best to their environment. Charles Darwin. SPARX Group Company, Limited is a publicly owned asset management holding company in Japan. Its origins date back to 1989, when Shuhei Abe founded SPARX Asset Management Company, Limited in Tokyo. Focusing on Japanese equity research and investments since its inception, the company has transformed itself over the years from managing a small, cap value fund to long-short and macro-oriented strategies in Japan and throughout Asia. Listed on the Nasdaq Securities Exchange in 2001 under the name SPARX Group, it expanded its footprint to Korea in 2005 and Hong Kong in 2006. In 2001, SPARX's total assets under management amounted to $6.5 billion. With 170 employees, the company has a team of 49 investment experts located around Asia who search for value opportunities in the region. Its flagship fund, Japanese Equity Long-Short Strategy, which stresses value investing, has returned 145.8% since its inception in June 1997. This return equates to an annualized gain of 6.36%. During the same period, the Japanese equity market, as represented by the Topix Index, had a cumulative loss of -24.63%, or -1.92% annually. Throughout my investment management career, my goal has been to provide investment intelligence and solutions to those who want to invest in Japan, said Shuhei Abe, founder of the SPARX Group. Founded in Japan in 1989, SPARX stands for Strategic Portfolio Analysis Research Experts. To Abe, the name also signifies the sudden spark of an investment idea, the eureka moment. To generate that investment spark, an investor needs to remain open and be receptive to new insights and information, Abe said. In 1985, when he was 31 years old, Abe formed Abe Capital Research in New York. Starting with $30 million in funding from a wealthy Greek coffee business family, the company focused on investing in Japanese equities. Taking a value investing approach, Abe's first focus was the Japanese railway sector. He found many railway shares to be attractive because investors valued them on the basis of P/E multiples alone, totally ignoring the market value of the assets on the balance sheet. Railway companies feared that the government would cut fare prices, and so they had purchased a great deal of land over the years to push down profits. When the property market boomed in the 1980s, this land became extremely valuable. Abe's unique insight into the fact that railway shares were trading many times lower than the market value of the land held by the railway companies gave him the conviction to invest heavily in the sector. However, as Abe Capital Research served only one client, the railway investment focus was underappreciated. To spread the news of his value proposition, Abe decided to send out a research report, titled, "Takeover Opportunities in Japan," to 10 of the largest U.S. investors he could think of. One open-minded individual replied, "George Soros of the Quantum Fund." I was surprised when Soros called to inquire about my investment ideas in Japan, Abe said. I had a 2-hour meeting with him afterward, and he gave me $100 million to act as his satellite manager. Considering that the Quantum Fund was about $1 billion in size at the time, he entrusted me with quite a lot of money. Abe continued, looking back, I think the reason why Soros hired me was because he had the conviction to allocate capital to Japan in the first place. Because he was already in his late 50s, he could not run around and do everything on his own. I was lucky to have sent out the research report at the right time, and he probably found me to be analytical, energetic, and honest, and so he gave me his trust. Abe's railway investment idea played out well. Despite the Black Monday crash in October 1987, railway stocks were up about 5-fold by 1988. As Soros felt that the Japanese market was reaching its peak in the late 1980s, he decided to pull his capital out of Abe Capital Research in 1988. In the same year, Abe also decided to close down his company in New York, and he returned to Tokyo to launch SPARX Asset Management in 1989. The 2-year working relationship with Soros proved invaluable to Abe. I would not be doing what I am doing today if not for Soros. Although I did not learn any specific investment valuation models from him, he gave me the opportunity to understand his investment mindset, how he perceives information and evaluates market cycles. For example, he taught me how to make contrarian bets by shorting various stocks on Black Monday in 1987, and how to profit if the asset bubble burst in Japan. Abe added, although our idea of shorting the market was correct eventually, we were a little too early in the game. Parting with Soros, however, was a blessing in disguise for Abe, as the incident led indirectly to his return to Japan. He knew that if he were to show his Japanese market intelligence to investors, being in the country would help him to be more competitive. In addition, Abe and his wife, Tomoko, whom he married in 1985, were ready to return home. A musical beginning. Born in 1954 in the northern Japanese city of Sapporo, Shuhei Abe grew up in an entrepreneurial environment. His father, Koji Abe, was an iron factory foreman before he and his wife, Mitsui, decided to start their own ironworks factory in their garage. Abe recalled, "My memories of my childhood years suggest that my parents were constantly working. I remember my mother always carrying my younger brother on her back while she made and painted bathroom chimneys in the factory. Back then, with coal and charcoal constituting the main sources of household energy, including the heating of bathwater, bathroom chimneys were commonly found in Japanese homes. In the 1950s, Sapporo was still a small town. The streets were not paved, and horses were still the main source of transportation. Everyone was poor, but hardworking. Our spirit was positive. What we were taught at the time was that Japan was a poor country, and the only way to take the country forward was to trade goods with other places," Abe said. Because both of my parents worked and had their own small business, we were not that rich, but compared to others, we were relatively wealthy. I remember we were the first family in our neighborhood to have a television set. Whenever there was a sumo wrestling match, everyone would come to our place to watch it on TV. Abe was the eldest son in the family and had 2 younger brothers. Although he was conscious of the hardships his parents faced, he always intended to follow in his father's footsteps. However, before making a success of the family business, he wanted to take a life detour and become a musician. As a child, Abe was a member of his school's choir. With sponsorship from the local television station, the choir performed on a variety of TV programs. Thanks to these public appearances and the encouraging feedback he received, Abe learned to play the guitar and became a country singer as he entered his teens. I had been a top student, but my interest in music distracted me, Abe confessed. I would practice the guitar all day and even sing in the street, and my grades became simply average. Passion is one thing, but reality is another. Abe knew that he was a good guitarist and a decent singer, but the reality was that it would take a much greater effort to reach the professional level. He explained, "It is important to have passion, but at the same time you need to judge yourself objectively. I enjoyed music, but I was not up to professional standards. I believe that every human being has an artistic gene, and in his or her lifetime can create at least one masterpiece that is globally competitive. However, to become a professional, you need to replicate your talent again and again if you are to have more than one masterpiece. It is the same with investing. You can be passionate about it, but if you want to become a professional investor, you need to develop a system and have the talent to find good investments repeatedly." Facing the truth, Abe decided to study economics at Sophia University in Tokyo in the hope of learning some business skills, before joining his father's company. Although his university courses did not seem particularly challenging, Abe also decided to take a night class to study English. He took an intensive course lasting 3 hours a day. After 2 years, only 20 of the 200 or so students in the class managed to pass, and Abe was one of them. I think I was able to pass because I had more free time than my classmates. Many of them had to work part-time to support their families, but I was lucky because my father's business was doing well and I did not have to work. Besides, I worked hard in the course because I believed that knowing English would give me more opportunities to do business in other places, Abe said. Breaking the language barrier. With his new language skill set, Abe decided he wanted to explore the world. On the recommendation of his school chancellor, he was able to join an exchange program at Boston State College in Massachusetts. Then, upon completing his undergraduate education in 1978, he decided to remain in the United States to further his education. He applied for an MBA and was admitted to Babson College in Massachusetts. Becoming more serious about business, I studied very hard. After a year of accounting, finance, and economics courses, the 3 subjects suddenly came together and formed a uniform business structure in my mind. This was an enlightening experience for me because I began to look into company case studies and started trying to visualize their business models by looking into their numbers, Abe recalled. After nearly 3 years in the United States and with an MBA in hand, Abe's intention was to return to Japan to assist his father. However, the family company was severely affected by the oil crisis of 1979 and had to undergo bankruptcy-type restructuring. On his father's advice, Abe decided to gain work experience at a large Japanese corporation. He joined the Nomura Research Institute as a research analyst in the consumer electronics sector in 1981. I did not have a clear objective of what I wanted to achieve at Nomura. I only had the humble goal of becoming a better researcher and eventually writing a book. Because I could speak English, I was assigned to the New York office after a year with the company and became an equity broker, selling Japanese equities to American institutions, Abe said. Learning from the West. Once back in the United States, Abe realized he had no idea how to sell Japanese equities to investment institutions. His only advantages were that he was Japanese and could speak English. Abe explained, in the early 1980s, introducing Japanese stocks to American institutions was virtually impossible because they were not interested in the first place. I concluded that brokering individual Japanese stocks was not the right way to attract them. With nothing to lose as a young salesman in my late 20s, I invented the concept of portfolio selling, and luckily Nomura saw the value of it. Instead of selling individual Japanese stocks, which may have seemed too foreign and risky to investors, I studied research reports and analyzed all of the stocks that were recommended by our research team. Thinking as a portfolio manager, I then structured a portfolio and showed it to potential clients. Fortunately, my portfolio had gone up each time I showed it to them, and so little by little I gained new accounts. Abe believes that when an investment rationale is sound, all that is required is patience and persistence. The same holds true of sales and marketing. After more than a year of portfolio selling, Abe heard that the state of Tennessee was looking into diversifying its investment portfolio outside the country, so he traveled to Nashville to show the investment team his model portfolio. After meeting with the team every month for a full year, he opened a $50 million account for the Tennessee state government. I believe the investment managers in Tennessee were impressed by my persistence and honesty. Even though they gave me no business initially, I took the initiative to meet with them every month. In the end, they were convinced by my model portfolio, and their account turned me into Nomura's most productive Japanese equity broker, Abe recalled. While selling his portfolio in the American market, Abe noticed that Japanese brokers usually had the misconception that American investors wanted only to deal with Japanese blue chips, such as Sony or Toyota. In fact, this was not the case, particularly where value investors were concerned. Fred Reams of Reams Asset Management in Columbus, Indiana, who manages pension money, taught me about value investing and how to look into the balance sheet and to value hidden assets, Abe explained. He taught me to think beyond the Japanese way of valuing stocks, to disregard all of the blue chip recommendations by Nomura, and to come up with my own list of stocks that fit his value proposition. That was my first introduction to value investing. Abe then came across Fidelity Investments. Meeting the owner of the company, Ned Johnson, and subsequently getting to know its star fund manager, Peter Lynch, and Lynch's then protege, George Noble, Abe began to gain insight into how American investors apply fundamental research to stocks. Applying the American model, Abe soon came to realize how simplistic Japanese investors had been in their investment research. For example, in the 1950s and 1960s, Japanese investors looked mainly at dividend yields based on companies' book value. Because they overlooked earnings growth, many stocks such as Sony traded as low as 2 to 3 times P/E. When sophisticated foreign investors discovered these bargain Japanese stocks, the country was gradually introduced to the concept of P/E multiples, which then became the mainstream valuation metric in the 1970s and 1980s. In my experience, Western investors have a sophisticated way of valuing stocks. Although they do not normally change their way of looking at things, they apply that way of thinking to find opportunities around the world, Abe commented. Learning to become a value investor when I was still inexperienced in the 1980s, I had to change my way of thinking to fit the American model. I had to alter my method of cooking so they could eat it. If they did not like sashimi, raw fish, I might have to cook it. That was survival. When I started up SPARX, it also became my mission to use American valuation models to analyze Japanese stocks so that investors worldwide could better understand and appreciate the Japanese market. Applying his new mindset, Abe found bargains in Japanese non-life insurance companies. By looking into the balance sheet and digging into their assets, he discovered that many of these companies had huge portfolios of stock holdings that were worth many times more than their market capitalization. These companies were trading at market average P/E multiples, but had a breakup value many times greater than their share prices. Many investment institutions agreed with Abe about their attractiveness. After making a few successful investment recommendations, Abe started up Abe Capital Research in 1985, and then SPARX Asset Management in 1989. The evolution of SPARX. When he founded SPARX at the tail end of the 1980s, Abe found that Japanese brokers had become very complacent about the broader market. As stocks had done very well since 1986, investors found no reason to alter their investment mindsets. They believed that trading in and out of blue-chip stocks would make everyone rich, and no improvement was necessary. Abe said, "I found that no research was done on small Japanese companies because expanding into this category was a marginal business for large institutions." With the hype in Japan, even rational investment managers were forced to invest in the country, driving large-cap stocks to 70 to 90 times P/E. I knew that if I wanted to compete, I had to be different. Therefore, my strategy was to apply value investing to small-cap companies. Because these shares were more illiquid and brokers never attempted to pitch them to clients, they were trading at huge discounts with multiples in the low teens. Abe created a small-cap model portfolio and began to sell it to large foreign institutions with large-cap exposure in Japan. His rationale was that large caps were already trading at hefty premiums. Hence, if institutions did not own small caps, then either portfolios would become vulnerable in a downturn or, if the market kept rising, small caps would eventually become a value play. The idea was taken seriously by a sovereign wealth fund in the Middle East, and SPARX was fortunate enough to raise $100 million from the group. Although founding SPARX was a natural step forward for Abe, he entered the market at the tip of the Japanese asset bubble. 6 months later, Japan's main stock market index, the Nikkei 225, began to tumble. Fortunately, Abe's small-cap strategy survived the storm. He remarked, December 1989 was the peak for the Nikkei. For small caps, however, the index was only at 1,600 points and peaked a year later at 4,100 points. There was a time gap before investors began to realize that the main market was not working and decided to put their money into an alternative market, mainly small caps. Luckily, we benefited from that window of opportunity. Whatever we touched went up. The darkest period for SPARX and Abe came later in 1992. With the small-cap index, the over-the-counter JASDAQ market, declining rapidly in 1993, the company's revenues were barely sufficient to pay its analysts' salaries and Tokyo's high rents. Looking back, I should have realized that our chance of survival was close to zero. But I was still young and passionate, And my fighting spirit told me that I should not give up because I believed in my investment principles, Abe recalled. New funding from Warburg Pincus in 1994 revived the company's hopes, but investing during Japan's lost decade remained painful. In 1997, SPARX lost 20% of its managed capital while its benchmark index lost 41%. Abe explained, the market was declining. We were up for a couple of years, then down again. We always found ourselves back at ground zero. Theoretically, if the market is down by 20% and we are down by only 10%, our clients should be happy. But realistically, they are never happy because we are still down. In a crisis, value investors should be happy because they can buy cheap stocks, but in reality clients are always worried. To continue to bring Japanese market solutions to investors, we had to evolve. We had to build new trading skills that would allow us to fulfill clients' real needs, to preserve capital and generate positive returns. Accordingly, in 1997, we became one of the first to launch a long-short fund, one. Abe elaborated, Japan in the 1990s was at a very peculiar point in its history. Deflation was a concept we learned in economics. We never thought it would happen, but it did in Japan. In a deflationary system, investors should not, in theory, own equities because margins will contract as revenues decline while costs do not necessarily drop. In such a market environment, the only way to survive is to adjust, to change. By applying value investing to identify both bargain stocks and overpriced stocks, we were able to benefit from both a bullish and bearish stock market. Although such a long-short strategy seems to deviate from traditional value investing, Abe defended his logic. I think a good investor has to evolve his strategy over time to fit the market. But at the same time, he must be consistent with his investment philosophy and principles. If you look at Warren Buffett, his strategy is different from Benjamin Graham's original value investing principles. If he had not evolved, he would not have found great investments such as Coca-Cola. He improved his strategy by monetizing brand value, which was not a traditional value principle at the time. Building a Westernized Asia. Abe's logic paid off. SPARX became a market force in the late 1990s and 2000s, and is one of the largest investment institutions in Asia today. Although his strategy is value and his primary focus is Japan, Abe does not confine himself to the strategies he has developed. He said, as an entrepreneur, a value investor, and a believer in Japan and Asia, I envision my company as bringing a universal value judgment to different types of investors, breaking the barriers of culture, customs, and language. At the same time, we should not be complacent. We have to challenge ourselves to be creative and innovative. Otherwise, the market will abandon us through its own natural selection process. For Abe, innovation is essential. Businesses assume that capitalism works, but this ideology was developed in the West, not the East. The entrepreneurial spirit believes that capital has a cost, and the goal is to outperform that cost to create value. However, this way of thinking does not exist in traditional Asian cultures because the cost of capital was provided by the government to facilitate business and trade in ancient times. What is finally happening today is that Asian economies are freeing themselves from their old, non-capitalized structures, and so we must innovate to keep up with this change. Besides, if you look at Japanese culture, the dominance of the keiretsu, conglomerates of different businesses with interlocking relationships, has traditionally made Japanese investments unattractive because management serves its own interests, not those of shareholders. In order to improve, We need to bring businesses and the corporate culture forward. To promote and bring unity to the Asian market, Abe developed a Japan Value Creation Investment Strategy Fund in 2003. SPARX also teamed up with the California Public Employees Retirement System, CalPERS, and San Diego-based relational investors to promote corporate governance in Japan. By stressing earnings quality, business core competency, cost management, and shareholder value, SPARX became a new force in the market, facilitating and improving corporate governance in many Japanese companies. Not only has the fund generated hefty returns over the years, but it has also changed the domestic corporate culture in Japan. To expand its investment footprint, SPARX purchased an asset management company called Cosmo in Korea in 2005. Then, in 2006, it acquired PMA Investment Advisors Limited in Hong Kong. Abe believes that SPARX's expansion was a natural step in its evolution toward becoming an Asian investment house. In his words, "Our goal is to raise and strengthen the caliber and competency of our core franchise. Just like Coca-Cola, people buy it because it equates to quality, reliability, and a good reputation. When people seek investment services in Asia, we want them to think of SPARX as a quality brand they can trust." Searching for value. Value investing, to Abe, is locating the potential arbitrage opportunity between an investment's true worth and its market price. You have to ask yourself, why does this business make money? What is its sweet spot? Then, you take the management perspective and consider how much the business is worth. Investment analysis is both art and science. He explained further, the artistic or qualitative side of investing is probably innate, but then experience can sometimes improve upon nature. For example, the way Warren Buffett judges his managers is an art, but he has improved upon that art as he has gained more life experience. One thing Abe has learned over the years is that one has to stay focused. Instead of understanding and analyzing different types of investments, the wise investor should remain dedicated to a particular asset type, and find the one that best suits his or her personality and risk tolerance. Abe put it this way, "Maybe I would enjoy looking into bonds or other countries, but my focus has always been Japanese stocks. That is my market intelligence." In addition to focus, an investor also requires vision. You need to be a visionary in times of opportunity or crisis because you cannot analyze the world in a linear fashion. While you have the facts, which are based on the past, you need to visualize the consequences, which will take place in the future. The scientific or quantitative aspect of investing is a skill set that can be nurtured. Abe explained that when he first started SPARX, the company could not afford to hire experienced staff. Japanese culture also hindered the firm's ability to hire talent from good schools, because such graduates traditionally are averse to taking the risk of working for small, unknown companies. Accordingly, Abe had to build his team slowly and groom his analysts one at a time. Abe said he felt like a high school coach, guiding young individuals in taking a systematic approach to analyzing companies. Eventually, they became experienced analysts who supported the early growth of SPARX. He added, "Investing is also about establishing a well-defined strategy. At the same time, you must never let numerical targets or the desire to chase investment returns for the sake of it to hijack your principles and strategy. When an idea comes to you, you need to brainstorm, to be creative, think about the past and future, and test your thesis. Then, you need to have a systemized way to analyze the potential worth of the investment and how much return you can generate from it. When investigating a stock, I look at all of the simple measures that any ordinary investor would ask about. Then, I want to find out how much the investment should be worth in 2 to 3 years' time. We want to test our assumptions, play with the sensitivities of our assumptions, and set a target for the investment. Unlike the market, which defines long-term as a 1-month time period, we want to focus on the merits of the underlying business. Although we can project earnings many years ahead, these numbers can become vague and meaningless because the world is uncertain and constantly changing. As a value investor, my aim is to project the worth of a business up to 3 years. Anything after that becomes a speculative exercise. To generate investment insights and ideas, Abe and his team meet most Thursdays at 7 a.m. for a 1 to 2 hour brainstorming session over coffee and breakfast. He calls it the Buffett Club. This brainstorming session allows the company's analysts and portfolio managers to challenge one another freely over stock ideas and economic viewpoints. Sometimes they even discuss their favorite investment books to spark insights. Abe's favorites include Benjamin Graham's The Intelligent Investor and George Soros's The Alchemy of Finance. Abe said, "When conflicting viewpoints arise during the session, we return to the original aim of the debate, refocusing on the numbers and figures. Sometimes the artistic side of the brain makes a good case for the future, but sometimes it is the scientific side. The future has no right or wrong, so it is important to set an objective and to balance out all assumptions. Of course, common sense and experience should not be forgotten." Reflecting on his life, Abe said he appreciates the immense opportunities Japan has provided him with. Although the harsh realities of the business environment over the years made every step he took uncertain, he learned that luck is only a bonus in the investment business and that overconfidence is an ingredient of failure. The hardship of selling Japanese equities in the early days, the founding of SPARX during the hype of the asset bubble, and the subsequent adjustments in investment strategies effectively nurtured Abe to become an investment manager and human being who understands the feelings of others. In this sense, hard work, honesty, and the utmost sincerity are the virtues that Abe relentlessly upholds. As the world was beginning to recover from the internet bubble, the 9/11 terrorist attacks, and the severe acute respiratory syndrome (SARS) outbreak, Abe wrote this passage in October 2003. "Tomorrow is a continuous flow from yesterday and today, while the key is to always do your very best, day after day, while never cutting corners along the way." Within the repetition of this trial-and-error process, tangible patterns will gradually come to view. In the beginning, the insights will be vague and ill-defined. But in time, this will change to a sense of more concrete confidence and conviction. Indeed, this is the spirit of SPARX and the motto of value investor Shuhei Abe. Chapter 11. Eternal Sunshine of the Value Mind. Vinaya. Value Partners Group. It is easy in the world to live after the world's opinion, it is easy in solitude to live after our own, but the great man is he who in the midst of the crowd keeps with perfect sweetness the independence of solitude. Ralph Waldo Emerson. Vinaya is the co-founder of Value Partners Limited, a Hong Kong-based asset management company established in 1993 that applies value investing principles to identify investment opportunities in the Asia-Pacific region. The company reorganized itself as Value Partners Group Limited in 2006 and listed its business on the Hong Kong Stock Exchange in 2007. In 2001, the company was ranked the largest asset management company in Asia, managing a total of $7.2 billion. Its most notable fund, the Value Partners Classic Fund, a units had returned 1,756.4% since inception in April 1993, an annualized return of 16.9%. During the same period, its benchmark index, the Hong Kong Hang Seng Index, had returned 262.4%, or an annualized gain of 7.1%. Since stepping down from the day-to-day management of Value Partners in 1996, Ye's mission has been to spot new investing talent across Asia. In 2002, he co-founded and became chairman of Argyle Street Management, an investment company that seeks opportunities in distressed and special situation Asian investments using a value investing approach. In 2003, Ye joined Cheetah Investment Management Group as chairman to restructure the group into a fund of funds that identifies value investing managers and incubates value funds with Asian investment themes. My first real encounter of a market panic was Black Monday on October 19, 1987, when the Dow dropped more than 20%, Vinay Ye recalled. I was convinced that the world's economy would be falling into a severe recession, but shortly after, I was proven totally wrong with my outlook. Just 28 years old at the time, Ye realized that making macroeconomic predictions was simply too difficult for him. In hindsight, one may be able to tell what is right or wrong, but economic events occur and change so rapidly that even solid facts and figures can often lead to inaccurate judgments. Rather than focusing on economic figures, Ye decided to devote more of his attention to individual companies because their fundamentals are easier to understand. What I learned after Black Monday was that when a crisis hits, business sustainability is the biggest insurance against a downturn. In that sense, the cash flow generation in a business is the most fundamental and rational basis for determining value, Ye explained. Believing that independent thinking, a contrarian approach to investing, and the courage to act in extreme market conditions make life more fruitful. Ye has the personality traits of a true value investor. Before becoming one, however, he never intended to join the investment world. A multidisciplinary path. Born in 1959, Ye grew up in a prominent and respectable family in Hong Kong, although he is too modest to admit it. He merely mentioned that his parents, Mutsen and Zungsing, are refugees from Shanghai. His grandfather, Can Ne, owned a well-established construction company there before moving to Hong Kong in 1937 due to the political uncertainty in China. Abandoning almost everything, the Ye family arrived in Hong Kong and started a new life from scratch. At a young age, Ye was inculcated with a sense of value and humility. He explained, "Although I have been quite privileged, my family has always been thrifty. When I was young, I had limited pocket money and had to be responsible enough to budget and live within my means. My younger sister and I were taught about the meaning of money and materialism. After all, given the early hardship in my family's history, we were told not to get carried away in good times and flushed out in bad times." During his school years, Ye had a busy schedule, filled with schoolwork, tutoring, and sports. Apart from his interest in reading comic books and Chinese wuxia fiction to stimulate his imagination, he was always competitive at school. Ye left Hong Kong at the age of 16 to study in the United States, where he attended Milton Academy in Massachusetts and graduated cum laude in 1977. He then concentrated on Marxist history at Williams College, graduating magna cum laude in 1981 with a bachelor's degree in history. Explaining how he chose his college and subject of study, Ye said, "When I was young, I had no dreams. I had no idea of what I wanted to become and what I wanted to achieve. I decided to attend Williams College simply because it is a liberal school, and being liberal was kind of cool in the 1970s. After graduating, Ye decided he did not yet want to work. To prolong his time in school, he decided to study law at Columbia University. I knew that my history major would not find me a job, and I had no intention of studying the same subject at a higher level. Being liberal and all, I did not want to study business. The least of all evils, then, was to go to law school. Although many decisions may seem silly at the time, looking back, they often intertwine with one another to form a broader framework. Drawing on his leftist leanings and belief that a classless society should provide opportunities for all without prejudices due to birth, class, race, or background, in his law studies Ye wanted to explore how different constitutions juristically shape the behavior of different societies. By investigating such a subject, perhaps he could find meaning in life and discover a career path. In his pursuit of the law, however, Ye soon became interested in another subject. During my law studies, I clerked for 2 summers. Those experiences strongly showed me that my personality was not suited to becoming a lawyer. One semester, however, I took a securities regulation class and had the opportunity to learn from some investment bankers. I found investment banking intriguing and decided I wanted to try out corporate finance. Despite his newfound interest, Ye managed to graduate from Columbia Law School in 1984 as a Harlan Fiske Stone Scholar, one of the highest academic honors the school confers. After passing the California bar exam at the age of 25, he accepted an offer to join investment bank Lazard Frères in New York. Ye now had to face his first challenge in the real world without any formal finance or accounting training to draw on. Admitting that it was a swim or sink in his first 6 months on the job, he had to outwork everyone else just to survive. Fortunately, with his multidisciplinary background, competitiveness, and all-around academic excellence, he excelled under pressure and managed to keep up with the ever-changing and fast corporate pace. At the New York branch of Lazard Frères, Ye first worked in the corporate finance division, and then switched to specializing in mergers and acquisitions. In 1988, he was relocated to London as a proprietary trader in risk arbitrage. Then, in 1989, he was named partner of Lazard Brothers Capital Markets. Recalling his days at Lazard, Ye noted, because the firm was less structured than big investment banks, I was allowed to delve into areas of my own interest, moving from one division to another. To this day I am grateful for the variety of opportunities that were given to me, especially when senior partner Peter Smith from the corporate finance division took a chance on recruiting me even though I had no finance background. Although Ye gained investment knowledge from different senior partners at the firm, he said that his most memorable investment lesson came from his own folly. The first trade of my career came from the recommendation of a cold call broker. He pitched pork belly futures of some sort, and I listened. Soon enough, I lost 2 months' salary. The lesson was painful but crucial in my investment career, as I learned the importance of doing my own due diligence before buying anything and to never take anyone's investment advice at face value. Looking back, Ye realizes that his freedom in choosing his early path was mainly due to his father's unconditional support, for which he is grateful. By the Chinese standard of my father's generation, my father was very open-minded. He never insisted that I go into the family business, and he told me that as long as I was passionate in what I did, then he would be fully supportive. His hands-off approach put me under no pressure, but indirectly he shaped me into a more responsible person. Indeed, when the Ye family's company, HSIN Chung International, had to go through a series of corporate restructuring, Ye felt that it was his duty to return home and assist his father. In 1990, he resigned as a partner at Lazard and officially moved back to Hong Kong, seeking a comfortable price. The Ye family decided to restructure its business operations after the Tiananmen Square crackdown in 1989. Confidence in China was badly shaken, and many of Hong Kong's businessmen were worried, especially because Hong Kong would be handed over to China in 1997. Ye explained, "Our company was a small entity listed on the stock exchange. The company engaged mainly in property construction, development, and management, and it also ran a shipping business. Since my father's siblings were worried about Hong Kong's future, we had to think of the best solution to bring liquidity to all of our shareholders. If we wanted to treat everyone fairly, we had to restructure our businesses." In a series of transactions, Ye split his family's holding company into two entities, HSIN Cheung Construction Group and HSIN Cheung International Holdings. Then, in 1992, he structured a leveraged management buyout deal to take HSIN Cheung International Holdings private. This transaction quickly brought Ye fame, as the financial community applauded his astute financial skill set and perfect market timing. In hindsight, we were very lucky because the buyout price that we offered was favorably received by minority shareholders. Given that the Tiananmen Square incident still overshadowed market sentiment in early 1992, our offer was considered very fair. If we had tried to squeeze our shareholders and delayed the transaction by 6 months or so, the deal probably would not have gone through because market sentiment changed positively after Deng Xiaoping made some bullish comments on the country during his southern China tour, Ye said. In March 1992, China's then paramount leader, Deng Xiaoping, made a historic visit to Guangdong province, which neighbors Hong Kong. During this visit, he made bold comments about market reforms to reassure investors and instill confidence. His catchphrase, "To get rich is glorious," ignited interest in investing in Chinese-speaking markets, such as Hong Kong, Taiwan, and Singapore. At the time, Morgan Stanley analyst Barton Biggs even said he was maximum bullish on the Chinese economy. Catching the rise in investment valuation in late 1992 and 1993, when Hong Kong's Hang Seng Index rose more than 30%, Ye was able to repay the debt he had raised for the management buyout by selling the company's shipping fleet, leaving the remaining assets of the newly privatized company with a zero-cost base. This transaction further boosted Ye's reputation as a market genius. He commented, "The deal looked as if we were good at market timing, but it was really just being fortunate and propitious." Looking back, what I learned is that in deal-making, or in investing, you can never tell what the best price is. All you can do is to come up with a price that you are comfortable with, and not second-guess what other people think or what the market thinks. Finding a value partner. After reorganizing the family business, Ye looked for new opportunities in Hong Kong. Although he still enjoyed reading comic books and had taken up skiing, neither was a viable career option. After some thought, he realized that his ultimate passion was investing. I did not know what value investing was in the early 1990s. All I knew was that I enjoyed doing my due diligence and making sure that I did not overpay for an investment. Exchanging ideas with different people, one day I was introduced to my future business partner, Chia Chenghai. As we enjoyed each other's viewpoints and investment philosophy, I came to realize that we were, in effect, value investors, said Ye. Chia, a native of Penang, Malaysia, started his career as a journalist. In 1989, he joined the Hong Kong branch of Morgan Grenfell, a London-headquartered investment bank, to conduct investment research on small and medium-cap companies in Asia. When Ye was privatizing HSIN Chung International Holdings, Morgan Grenfell was the financial advisor to the company's minority shareholders. Chia, as research director, was responsible for listing the deal's pros and cons on behalf of these shareholders. Ye has nothing but praise for Chia. I did not know Shanghai when we were privatizing HSIN Chung, but I came to respect him after reading his report regarding our offer. I found his due diligence and investment rationale very impressive and insightful. Representing the other party, he discussed his valuation fairly and stated his viewpoints clearly. He later got to know Chia better, and the two friends came up with the idea of forming an investment company, which they duly did, co-founding Value Partners in 1993. Ye recalled, "We started our first fund, Value Partners Classic Fund, with $5.6 million. With Chia, myself, and one secretary, we sublet a small room in my family's office. That was how it all started." He further elaborated, "If you ask me what we wanted to achieve, we really had no clue. All we wanted to do was to invest our own money, accept clients' money if they believed in us, and apply value investing to look for underfollowed and under-researched small-cap companies in Hong Kong." Reviewing the investment landscape in the 1990s, Ye noticed that even though Hong Kong was already an important financial hub in Asia, domestic investors had quite short-term outlooks and were speculative. Not many of them had prudent investment strategies, and their stock ideas came primarily from rumors and tips. The big institutions from the United Kingdom and the United States, in contrast, were mostly making their investment decisions from afar. Rather than focusing purely on stock picking, their strategy was to buy blue chips and large-cap stocks to track the broader market. In effect, they were more like global macro investors than real stock pickers. Moreover, their investment holding periods were not very long-term. Ye said, "Value investing was a relatively virgin landscape in Hong Kong when we launched our first fund. We did not find any competitor doing the same thing. By focusing on fundamental analysis, we tried to understand the corporate structure of companies, their business model, their cash flow management, and then we came up with the fair value of these companies as if we were going to take them private. We focused on the downside, and then we tried to buy them when they traded at discounts." He further elaborated on his investment logic. Investing requires a broad and lateral mindset. When looking for an investment opportunity, the first thing that comes to my mind has always been the cash yield. I always like to know how much cash a business generates. Evaluating the downside risk, free cash flow generation is what ultimately bails out a company in an adverse business environment. When it comes to selling, I always think about reinvestment risk. I think the biggest lesson I learned as a value investor is that most people underprice and underanalyze reinvestment risk because even if you make a good investment and sell it, eventually you have to reinvest that money. Since this reinvestment skill is vastly underestimated, the real distinction between a good and average investor is really that the former constantly has good ideas about reinvesting capital to create a compounding effect. Finally, holding for the long term and looking for underfollowed small caps, we started Value Partners with this motto: investing through discipline. To us, this saying is not a slogan to raise money or for promotion. We really mean it. We strongly believe that a value investor needs to be disciplined, and this quality has to be proven through time and through constant practice. Through disciplined investing, Value Partners has not only grown its assets under management to almost $9 billion as of 2011, it has also transformed itself into a stronger and better market player by weathering crisis after crisis. As Hong Kong has long been one of the most liquid markets in Asia, with capital flowing in and out freely, this unique financial center has always been affected by crises of some sort, whether domestic or international in origin. Ye commented, "In less than 2 decades of operation, we have gone through around 5 market cycles. Every 2 to 3 years, we have experienced a crisis, and we have emerged from each of them. These crises have given us more confidence, and have proven to us that value investing works." Looking back, Ye realizes that he has found his investment journey both fun and challenging. However, 2 periods gave him great cause for concern. One was a financially challenging period, and the other was psychologically exhausting. He recalled, "The 1997 Asian financial crisis and its aftermath were tough. We had a lot of fund redemptions, and it was a touch-and-go moment for Value Partners. With the stock market dropping over 50%, the Hong Kong government rescued it by buying a substantial portfolio of local blue-chip stocks to sustain the currency peg between the Hong Kong dollar and the US dollar. Since our holdings were mainly in mid and small caps, we were left in the dark. These stocks traded at as low as 3 times PE, and the pressure was intense, but luckily we endured it. Psychologically, we were frustrated during the dot-com bubble in the late 1990s and in early 2000. Because we were disciplined enough not to get into technology stocks, we were being laughed at and challenged by clients. With less than 1% of our portfolio in technology-related stocks, we survived the crash and proved that discipline was key. Prior to the internet bubble bursting, we were holding China B shares, 3 which nobody wanted. When the Chinese government opened up the B share market to domestic Chinese investors, our portfolio went up 80% while the market tumbled 50%. Spotting value mines. In addition to a busy business life, Ye has had a busy personal life. He married Mira Leung in 1994, and they had a daughter, Nadia, in 1996. In the year his daughter was born, Ye made the decision to step down from the management of Value Partners. Leaving co-founder Chia Chenghai as manager, Ye became honorary chairman and remains in close touch with the company to share insights and ideas. Ye explained his rationale. "Chenghai has been the chief investment officer from day one, and he should be credited for most of Value Partners' success. I was honestly just a partner who bounced ideas off him. Besides, having a trustworthy partner like Chenghai, the best strategy was to leave him in charge and let him do what he does best." Ye admitted that he is well aware of his weakness. "I know I am more of an entrepreneur than a real fund manager. Although I am very passionate about investing, I do not have the killer instinct that a good fund manager has. However, I am always the second man in the team to show support because my vision is for the long term." Ye had other reasons for stepping down from the management of Value Partners. In 1996, he was asked to sit on the listing committee board of the Hong Kong Stock Exchange. To avoid any potential conflict of interest, distancing himself from the day-to-day activities of Value Partners was the logical choice. Ye was also asked to oversee the family business, and decided it would be unfair to all parties concerned if his attention were divided. While running the family business, Ye continued to look for investment opportunities. In 2002, he co-founded another Hong Kong-based investment management company, Argyle Street Management, which focuses on investing in distressed assets. Ye explained, I found two partners, Kin Chan and Angela Lee, who exhibit very similar personality traits and a similar value investing philosophy to Cheng Hai, except that they engage in a different asset class and have different investment methodologies. Recognizing how talented and committed they are, I realize I was very lucky to team up with them. I was hands-on when the company was first set up, but once it gained traction, I learned to let go and let them run the business. Of his decision to step back from the front line to become the manager of investment managers, Ye commented, "I think many investors and even investment books like to discuss what the right investment style or method is, but I do not think we should get too bogged down with what is the right or wrong way in the first place. Instead, it is more appropriate to understand oneself before deciding on a specific investment style. If you are a calm and patient person, then the value investing approach may be right for you, but if you are jumpy and aggressive, then a more trading-oriented style may be more suitable. Investing is not about finding a fixed form, but about understanding your temperamental compatibility towards investing and improving your strategy through time and experience. Otherwise, you are always fighting against yourself." Drawing on this belief, Ye continued to look for new investment talent who shared his philosophy but applied different strategies in the market. In 2003, he joined Cheetah Investment Management as chairman to identify and incubate investment funds with different Asian investment themes. On the basis of value investing principles, he and his partners have launched a number of different funds within the Asia-Pacific region. Picking good investment managers is an art. Having partnered up with many value people for the past 17 to 18 years, I have developed something of an intuition about the body language of true value managers who mean what they practice. To me, it has almost become a matter of osmosis to understand their thinking and perspectives, Ye said. Good managers can deliver real long-term value, but we have to look beyond their latest performance records and understand their true personality and style first. Sometimes even when the personality and strategy of a manager make sense, performance may lag due to the stage of an economic cycle, so patience and a longer-term investment horizon are required. Becoming a man of value. Living in Hong Kong and seeing the influx of foreign capital due to the anticipated benefits of China's economic growth, Ye has experienced the meaning of globalization firsthand. Commenting on the so-called East-West divide, he said, "The world is getting smaller, and we should not make too much of the cultural difference between the East and the West anymore because globalization and the Internet have led to a convergence in the mindset of the younger generation. In terms of investing, the West has already developed its own method of valuation, while the East is still in the early stages of developing its own investment culture and mentality. Obviously, value investing is a good way to go, but it takes time for the average investor to understand its principles. As Asians also tend to have a disproportionate amount of their savings in property, the equity market still has a lot of room to expand, particularly when the upcoming middle class, mainly in China, begins to allocate capital to stocks. Looking ahead, what concerns Ye is global uncertainty, with the growing possibility of tail events, which, aggravated by the wrong political decisions, could easily send the world's economy into a tailspin. Since the fall of Lehman Brothers in 2008, for example, economic sentiments have been affected more by political issues than by financial ones. Ye commented, "In many situations, economists have proposed good ideas for how things can be done, but political constraints, as well as different political motives, have always ruined these good ideas. Although the world has become more uncertain and global markets have become more interconnected than ever before, Market volatility is really just a change in degree rather than a fundamental change. In this respect, I think the value investing methodology is just as pertinent and relevant today as it was when I started my career. The essence of value investing, to me, is the development of a sense of fairness and integrity because, ultimately, you are looking for a margin of safety by starting off from a point of conservatism. If you do not start off conservatively, you can have a high margin of error, which deviates from being a true value investor. If you look for the downside first, you tend to be more prudent, and this quality helps you form your own opinion rather than following the crowd. Then, when you are not easily swayed by others, you gradually gain a sense of fairness, not just as an investor, but also as a person. This school of thought really helps to develop the right temperament, which indirectly cultivates your investment process and strategy. For many years, Ya has woken up at 4 a.m. and gone to bed at 8:30 p.m. This disciplined routine began when he worked in New York. At first, it was simply a matter of waking up early to go to work, but then he began to push his limits by waking up slightly earlier each day, which gradually turned into the schedule he keeps today. Ya spends the first 2 hours of the morning clearing out his email inbox, a task he does not enjoy as he has something of an email phobia. Then, with that drudgery out of the way, he heads to the gym for a 2-hour physical training session. After reading the daily news, he spends the rest of the day at the office, either meeting with his investment partners or privately thinking and reading about the world. He modestly explained his current investment strategy. The way I generate investment ideas today is to be constantly on the lookout for good investment managers who can come up with good ideas. I am fortunate enough to learn from my partners, and since they are smarter than me, I mostly listen, although I occasionally chip in with my viewpoint and insights. Inviting Ya to lunch proves an economical exercise because he does not eat lunch. At most, he will order a Diet Coke. At 6 p.m. sharp, Ya returns home to spend time with his family. A wine lover who constantly searches for undercovered boutique wines, he may drink a glass or two before retiring to bed. Although he is too humble to admit that he is a successful person, Ya probably would not be able to deny that he is a man of value. Disciplined not only in investing, but also in ensuring his personal well-being. The quote that probably best captures Vinay Ya is that of Benjamin Franklin: "Early to bed and early to rise makes a man healthy, wealthy, and wise." Chapter 12. The Accidental Value Investor. Chia Shanghai. Value Partners Group. The unexamined life is not worth living. Socrates. Chia Shanghai co-founded Value Partners Limited in 1993. Based in Hong Kong, the asset management company has a mandate to seek underfollowed and out-of-favor investment opportunities in the Asia-Pacific region. Currently serving as chairman and co-chief investment officer, Chia is responsible for the company's various investment funds and its overall business direction. Voted among the most influential individuals in the investment business by a number of business magazines, including Asian Investor and Finance Asia. Chia is well on the way to meeting his objective of transforming Value Partners into a world-class investment firm. His dual mission is to introduce and to promote value investing in Asia by constructing an investment process by which ordinary investment teams can achieve extraordinary investment results. The company motto is, "Investing through Discipline." The largest asset management company in Asia, with $7.2 billion in total assets under management, Value Partners is also one of only 2 investment companies listed on a stock exchange in the region. Its flagship fund, Value Partners Classic Fund, units, saw a total return of 1,756.4%, or 16.9% per annum, from inception in April 1993 to December 2001. Its benchmark index, the Hang Seng Index, returned 262.4%, or 7.1% annually, during the same period. I have dedicated myself to lifelong learning, said Chia Chenghai. When I was 25 years old, I changed my personal signature to Learn, because I knew so little about the world and wanted to learn something new each day. In fact, I believe that learning is the only way to become a civilized and responsible human being. Having narrowly avoided dropping out of school on several occasions, Chia appreciates firsthand what a privilege learning is. Born in 1954 in Penang, Malaysia, Chia was among the poorest of the poor in his early years. Malaysia was a third world country when I was growing up, and there was no social safety net to speak of. When I was 12 years old, my father passed away after a period of ill health. With no source of income, my family, including my mother and a younger brother and sister, were literally in danger of starving to death. We moved from house to house and regularly faced eviction because we couldn't pay the rent. As the eldest son, Chia was forced to go to work to keep his family alive. He recalled, "I sold pineapples on the roadside 7 days a week, and I also worked as a hawker selling noodles. School became a part-time leisure activity, and I couldn't even have personal dreams because I was simply clinging on for survival. My mother hoped that I would one day become a clerk so that I wouldn't have to work in the sun." Chia aimed a bit higher. Determined to escape from poverty, he studied hard and earned a scholarship to the Penang Free School, an elite secondary school. To avail himself of this learning opportunity, he had to endure a daily 45-minute bicycle ride each way to school. When his bicycle was stolen, he reluctantly had to skip school for a few weeks until an uncle came to his rescue and gave him a used bicycle. He recalled, "Although my school career was difficult, I had a few claims to fame. I was the junior chess champion at my school, and was considered one of the best young writers in Malaysia. One of my short stories was published in a British magazine, and I wrote a piece on the exploitation of child labor based on my own experiences. After taking my O-level exams at 17, I was forced to leave school and find work to support my family." As Penang suffered a high unemployment rate in the early 1970s, finding a decent job was not easy. The only opportunity that presented itself in 1971 was a job folding newspapers for the Star newspaper, at a salary of 3 Malaysian ringgits per night, equivalent to roughly $1 today. Although he went home each night with his face and hands covered in black ink, Chia nevertheless considered the job a blessing because he could at least read the news for free. 3 weeks into his new job, Chia was granted a considerable promotion to trainee reporter. He explained, "The editor of the Star found out that I had won some literary prizes during my school years, and so he gave me a chance to become a crime reporter. As no one initially taught me where to look for crime stories, I had to take the initiative. I drove a motorcycle around town, listened to the police radio, and talked to different people to look for leads. Almost half of my stories were based on self-generated ideas and investigations, and my hard work earned me a promotion to sub-editor of the Star in 1974. Realizing that his career prospects would be limited if he remained in Malaysia, Chia began to look farther afield in Asia. When he was offered a sub-editor's position at the Hong Kong Standard newspaper in 1974, he accepted without hesitation. In August of that year, Chia packed his bags, boarded a cargo ship, and set sail toward a new life. Just 20 years old and with virtually no knowledge of financial markets, Chia would have been very surprised to hear that he would be managing an investment fund in 19 years' time. He confessed, "Long-term planning was not on my agenda. I drifted from situation to situation, simply responding to opportunities as they arose. My lack of interest in investing at the time is not that surprising. I simply had no money to invest." After several years at the Standard, Chia joined Asia Week and then moved on to the Far Eastern Economic Review and finally the Asian Wall Street Journal. Initially, he covered a variety of news stories in Hong Kong, but as the city cemented its position as an Asian financial hub, his focus gradually narrowed to economic and business news as his journalism career progressed in the years up to 1989. To ensure that he could write in-depth and accurate stories, Chia had no choice but to further his education by reading widely in a variety of areas. He explained, "Having the opportunity to interview prominent political and business figures in Asia gave me deep insight into the region. I learned that business cannot be carried out unless you understand the political, social, historical, and financial aspects involved." That realization prompted me to read a lot of history. I was particularly interested in the British Empire, as Hong Kong was then a colony and my home country of Malaysia had once been. I was fascinated with how Britain, a small island nation, had managed to dominate the world for so many years. That in itself is one of the wonders of the world. Reading history also equipped Chia with a better understanding of Asian politics and sparked an interest in finance. He recalled, "After learning about financial modeling and accounting, I came upon The Money Masters by John Train, which taught me how good investors invest their money." Although I initially studied these subjects to become a better journalist, in the end I developed a passion for finance and investing. Whereas an average journalist reacts to an event by researching and then reporting it, an above-average journalist anticipates and prepares for an event before it takes place. Chia commented, "What I learned as a journalist also applies to investing. First, good ideas are often self-generated. They come by taking the initiative to learn about new things and by paying attention to detail. Then, it is about prioritizing well and focusing on the main points because much of what we read and hear is pure noise, not useful information. When you are knowledgeable and focused, you are better prepared for whatever events take place. If you are a journalist, then you are able to break the news faster and with greater accuracy than your peers. If you are an investor, then you are able to react more quickly and decisively to opportunities as they arise." Such knowledge and focus has certainly borne fruit for Chia. In 1983, when he was with the Wall Street Journal Asia, Chia was the first journalist in Asia to break the news that the Hong Kong dollar would be pegged to the US dollar. The same year, while investigating the red-hot Hong Kong-based conglomerate Carrion Group, Chia discovered that the company had incomprehensible accounting practices and was involved in strange dealings with Bank Bumiputra Malaysia. The company soon collapsed amid a chain of dramatic events, including accounting fraud allegations, the suicide of a company advisor, and the murder of a Malaysian bank auditor. Chia's resulting story in the Asian Wall Street Journal was an impressive combination of crime investigation and in-depth analysis of the company's financials. Throughout 1983 and 1984, Chia specialized in investigations into banking scandals in Hong Kong, including the collapse of Kawa Bank and the Overseas Trust Bank. In 1986, Chia carried out an investigation of the Philippines Central Bank and broke the news that it was cooking its books. He also achieved journalistic prominence with his on-the-ground coverage of the People's Power Revolt on the streets of Manila, which led to the fall of President Ferdinand Marcos. Chia said, "After working in journalism for 18 years, I came to the conclusion that I had quite an aptitude for in-depth investment research. Through a friend, I met Mr. Si Fu Hua, then the head of investment bank Morgan Grenfell in Singapore. He asked me whether I would be interested in joining the bank as an investment researcher. With nothing to lose and a desire to try something different, I left journalism and became a stock analyst, starting an investment hobby shop." His new career could have had a shaky start. 1989 was a bad year to do anything in Hong Kong because of the Tiananmen Square incident in China, Chia recalled. "Fortunately, Mr. Xi offered me a job as head of equities research. He was interested in setting up a broking division in Hong Kong for Morgan Grenfell, and he needed someone to cover equities. In our initial meeting, Mr. Xi asked me why he should hire me. I answered that in any business, there is value added, and then there is differentiated value added. Although everyone tries to add value to whatever he or she does, I could offer something different thanks to my background in journalism and my research on a wide range of topics. My analysis would offer a different perspective from my competitors. In essence, my expertise was one of a kind." Chia noted that finance was a comfortable industry to be in the 1980s. Bankers and brokers enjoyed long lunches and, in the main, followed only the Hang Seng Index, which consisted of just 33 stocks at the time. Everyone traded in and out of those 33 stocks and made a comfortable living. Not being comfortable with merely being comfortable, Chia decided to draw on his unique investment insight and focus on medium and small-cap companies to distinguish himself from the herd. With his boss's approval, he began his new investment journey. In addition to generating investment ideas for Morgan Grenfell, Chia became a proprietary trader for the firm. His ability to analyze the stock market not only from a financial viewpoint but also from historical, political, and social perspectives allowed Chia to interpret economic reality more accurately than his peers. Accordingly, he generated hefty profits for the firm and received year-end bonuses that exceeded his expectations. In 1992, Chia encountered his future business partner, Vinay Ya. Vinay had returned from the U.S. with the intention of privatizing his family's company, HSIN Chong. As Morgan Grenfell represented the company's minority shareholders, I was responsible for assigning a fair value to the company's worth. Although Vinay and I represented opposing sides, I came to respect his intelligence and honesty. I knew that if I ever decided to start my own business, he would be a good person to talk to, and even to partner with. In 1993, Chia did indeed start thinking about launching his own investment firm. After working at Morgan Grenfell for a few years, and having earned a considerable amount of money, he felt it was time to control his own destiny. He elaborated, honestly, "I had become a little fed up with the finance industry and wanted to do my own thing because the industry was, and probably still is, full of what I call financial pirates. These individuals join finance not because they are passionate about investing, but because they have the money disease. Because they think the industry will enable them to make a lot of money, so instead of becoming engineers or lawyers they become bankers. They are a disgrace to human civilization because they contribute nothing. If you are a good doctor, you may make a lot of money, but you are probably also adding value in your field. These financial pirates, in contrast, make a lot of money by destroying value and hurting ordinary investors. They are even more dangerous than Somali pirates because they are undetectable. They are well educated, come from a good background, and dress in nice suits, but they prey on the market by creating and selling investment products that investors shouldn't buy or don't need. Determined to ward off the money disease, Chia decided to do his own thing and focus purely on investing. I knew that if I had the right principles, I wouldn't need to chase money. It would chase me. The right principles, for Chia, led naturally to value investing, with its focus on financial analysis and investment valuation. I wouldn't be trading in and out of stocks without a valid reason. On the basis of that simple concept, Value Partners was created. Chia took his business concept to Ya, who happened to share the same viewpoint and aspirations, and the two teamed up, officially co-founding Value Partners in Hong Kong in February 1993. Chia recalled the early days. Vinay and I laugh about it now, but when we started the business it was just me and him and a secretary. We raised $5.6 million, which was basically our own money, and ran the company like a hobby shop. Some people sell collectible toys and model cars, we sell prudent investment analysis and value stocks. Building a value temple. To protect themselves from the money disease and to add real value through individual stock picking, Value Partners focused on small to mid-cap companies in Hong Kong. This investment strategy allowed the firm to differentiate itself from most of the funds available at that time, which mainly offered investment products that closely tracked the Hang Seng Index. The two partners quickly settled into well-defined roles. Chia focused on investment analysis and stock picking, whereas Ye concentrated on fundraising. There is a big difference between being a good analyst, a good fund manager, and a good chief executive. Just because you have the skill to analyze investments doesn't mean you have the killer instincts or decisiveness needed to pull the trigger as a fund manager. Even if you are good at both, that still doesn't mean you can raise capital and run an investment fund properly. Fortunately, Vinay and I teamed up well, and we complement each other. Chia believes Ye to be a rare value investor in Asia today. He explained, first, he comes from a very good background and has a good network. Second, he understands the difference between value investing on a theoretical Grahamian basis and applying that theory realistically, and building a business on it. Running a fund is three-dimensional in nature. You have to deal with the structure and maintenance of the fund, you have to deal with clients and employees, and then, of course, you also have to deal with investment analysis and portfolio management. I am very fortunate to have a partner like Vinay, who has managed to traverse the gap between armchair value investor and what I call a master of fund management, in a three-dimensional way. He has taken the value investing philosophy and translated it into a solid business model in Asia. Thanks to Ye's strong support and Chia's investment intelligence, Value Partners began to take off in the mid to late 1990s. As the company began to hire more people, Chia recognized that he was at the forefront of building a value culture in Asia. To instill the firm's employees with the right spirit and mentality, all newcomers are required to sign an agreement that Chia calls "My Promise." It is mandatory that all employees frame this agreement, which comprises the following 10 cardinal rules, and display it on their desks. Be honest and straightforward, put my pride, not my ego, into the job, always strive for self-improvement, put clients' interest first, be fair and responsible to shareholders, keep our workplace free from office politics, keep secrets, maintain confidentiality, uphold our reputation for creative high-value solutions, emphasize a user-friendly, cost-effective approach, focus on concrete results, not excessive procedure. Chia hopes that signing "My Promise" will encourage all of his employees to lead moral and respectable lives. To weed out financial pirates in disguise, he looks for what he calls a learnability and a teachability. He commented, "When I evaluate potential employees, I try to determine whether he or she is learnable and teachable. For example, can they learn new things, and then can they teach what they have learned to others? Sometimes, good students are not good teachers, and vice versa." Scoring high in both categories requires an open mind, humility, and willingness to share. When I was a journalist, I started each assignment with a clean sheet of paper. To write a good story, I constantly had to find new ways to improve my learnability. Then, because I had to write the story up in an understandable way, I also had to improve my teachability. These two concepts are also important in investing. In building a value temple in Asia, Chia has instilled Buddhist teachings into the company's culture. Value stocks by their nature tend to underperform the market in the short term because they are usually out of favor, or have been overlooked by investors. Chia often reminds his colleagues of the importance of perseverance and fortitude, basic tenets of the Buddhist faith, in remaining calm in the face of such underperformance. Also of relevance is the Buddhist emphasis on selflessness. Chia elaborated, "To build a long-lasting business, it is important to drop one's ego and to let go of the self. In that respect, I would never want value partners to become dependent on a particular investment star. Avoiding such dependence requires building an investment process that can be carried out by a group of above-average individuals, and then making sure that process is learnable, teachable, repeatable, scalable, and sustainable. Obviously, you need a leader to guide the team, but the overall process has to be carried out by the team. Although each individual on the team may have limitations, teaming up allows each of us to focus on our strengths and maximize our capability. It may sound odd, but my ultimate goal is to industrialize this investment process and turn value partners into a factory that produces value investment ideas. We have proven that we can beat the market as a team, so maybe our process is repeatable and transferable. An industrialized process." Chia noted that the framework underpinning his industrialized investment process originated in the West, where its proponents include such well-known value investors as Benjamin Graham and Warren Buffett. His own contribution to the process has been to adjust its concepts to render them more applicable to the Asian environment. In formulating investment ideas, Chia and his team look for the 3 Rs, the right business operated by the right people and selling at the right price. In the process, they think as contrarians and divide the Asian stock universe into 3 categories. 1. Undervalued and out-of-favor stocks. 2. Fairly valued and highly recommended stocks. 3. Overvalued concept stocks. He explained, "Our main job is to invest in stocks in the first category and perhaps in those that fall between the first and second. Sell-side analysts tend to recommend a lot of Category 2 stocks, which we are always skeptical about. As for Category 3 stocks, they are the ones recommended by the media and taxi drivers. We aim to buy Category 1 stocks consistently and wait for them to become Category 2 stocks. When they begin to approach Category 3, we sell." Although this approach may sound simple in theory, in practice it can be rather challenging. Chia noted, "No Asian investor likes to stick his or her neck out and buy an unpopular item. Unlike the American stock market, which has ample liquidity, undervalued stocks in Asia can have zero volume on a trading day, and so the buying and selling process can be painful. After categorizing stocks in this manner and preliminarily looking at the valuation of those of interest, the next step is in-depth research into the underlying businesses. Chia and his team have standardized their valuation model and comparison metric to allow them to compare stocks within and across industries, quantitatively. In the 1990s, Benjamin Graham's security analysis served as the team's reference book, but since then they have been using Martin Fridson's financial statement analysis, a practitioner's guide. Chia elaborated, "We are increasingly focused on qualitative research rather than quantitative analysis because in Asia, stocks that are selling cheap are likely to be in a lousy business, that is, they are nothing but what Graham calls a cigar butt, stocks that have only a few puffs left. Even if bought at a good discount, these businesses can still go under because they lack sustainability and competitive advantage." Chia said that Value Partners now focuses on business strength and core competence, and the firm's team of analysts visits as many as 2,500 companies a year, kicking tires to distinguish the good from the bad. Once an opportunity has been identified, Chia and his team carefully deliberate before making an investment decision. "I think decision-making is often neglected as a process because when it comes to investing, someone has to pull the trigger," he said. Oftentimes, if you were to ask a team of finance professors to actually pull the trigger on a billion-dollar decision, they probably couldn't because they are too academic, Chia continued. "And sometimes as an analyst, even if you know you are theoretically correct, you are still afraid to make a decision because you don't want to be blamed if things turn out wrong. I call this a lack of killer instinct. To avoid that kind of indecision, we never blame anyone for making an investment mistake. However, that doesn't mean we make decisions casually. Instead, by applying Buddhist teaching on removing the self from the equation, we let go of our egos and do not worry about what others will think of us if we turn out to be wrong. Then, as we focus purely on the facts, we come up with an objective decision." That said, Chia emphasized that we are far from being invincible. We do make mistakes. In fact, analysis of our decision-making process since 1993 shows that we have made the wrong decision about 1/3 of the time, with another third of our decisions neither right nor wrong and another third spot on. To outperform the market, we must minimize our losses on mistakes by constantly monitoring our portfolio and distinguishing the good and bad stocks within it. In this respect, Chia likes to paraphrase Socrates, "Those who know they know nothing, and those who know they don't know everything." Humility will get you farther in the investment game than pretending to be intelligent. In his early days as a fund manager, Chia believed in having a very concentrated portfolio, but later he came to the conclusion that a diversified portfolio makes more sense. He explained, "At first, I was proud to have a concentrated portfolio of around 30 to 40 stocks, but then I began to realize that there are simply too many crooks out there who sound and look convincing, but end up cheating us as shareholders." In addition, there are numerous external forces affecting companies in Asia, whether they be business, economic, or politics-driven. To protect ourselves from losses, it is wiser to have a diversified portfolio in which no single stock accounts for more than 2%. When Value Partners was still relatively small, it invested by buying stocks outright in the open market. As the firm's total assets under management grew, however, buying the stocks of small to mid-sized companies became virtually impossible due to the limited liquidity in the open market. The liquidity issue, in fact, got Chia into trouble. In December 1998, the Hong Kong Securities and Futures Commission, SFC, publicly reprimanded Value Partners and Chia for placing a number of buy orders on 5 stocks before the close of the trading day, thereby artificially inflating their closing prices. The SFC released a statement that read, "Although unintentional, Chia should have known that trading in this manner had the potential to affect the closing prices of the stocks, and could therefore have been prejudicial to the integrity of the market. Chia explained, "It is impossible today to explain how difficult it was to have a portfolio specializing in small-cap stocks in the 1993 to 1999 period. These stocks were like private equity, and there were days on which they had no trading volume at all. Then came the financial crisis of 1997, and toward the end of 1998 there were months in which every possible buyer and seller of our stocks had simply disappeared. We tried to create a market by either buying or selling a security until we hit a counterparty, but there were none. To the general public, we appeared to be engaging in price manipulation, but what actually happened was much simpler than that. In any case, I took full responsibility and explained the reasons for our actions to the SFC. Although they accepted them, they were not satisfied and gave us a warning." Having learned his lesson, Chia revised the firm's investment process by adding a specialized team of stock dealers to facilitate investment trades. Moreover, as Value Partners had become quite a large company by local standards, Chia decided that taking positions on small companies required a different approach. He said, "We can easily buy 5 to 10% of a small company these days. To leverage on our size and reputation, we often structure a deal to buy a single block of shares directly from the company rather than buying it on the open market. In American terms, this is known as private investment in public equities, or PIPEs for short. The beauty of this kind of transaction is that we can buy at a discounted market price or structure a convertible bond with the company. Once this has been accomplished, Chia and his team monitor their investment positions closely. Adding a journalistic element to the exercise, Chia asks his colleagues to imagine what the newspaper headlines on their holdings would be. He elaborated, "I like to ask my team to visualize the future, to imagine what journalists will write about the company in 3 months or a year. In response, they will often simply consult the price chart. But I don't want that. I want a true visualization of the future. A value march forward." Reflecting on his years at Value Partners, Chia believes that the most memorable event in the company's history occurred between 2001 and 2002, when its total assets under management reached the $1 billion mark. He recalled, "There was a bit of disunity on the team at the time because some people wanted to close the fund and keep the company small, whereas others wanted to grow the company to show the world that an Asian asset management company could raise serious money and be sustainable. I happened to be on the side of those who wanted to pursue growth." The debate went on for months. Although I agreed that the selling point of an asset management company is its performance, not its size, I eventually won the debate, not because I was the co-founder of the firm but because we, as a team, had created a thorough investment process whose application allowed us to form small units within the firm in a kind of military formation. Doing so permitted us to retain a small unit culture while becoming large as a whole. Today, we have around 6 units, each of which has 5 to 6 members managing their own fund. These units are semi-autonomous. Hence, their members do not feel like they are working for a big company, and so are still hungry, passionate, and innovative. Our motto is, small enough to be effective, big enough to be strong. In Chia's position as chairman and co-chief investment officer of Value Partners, providing leadership and direction requires an extra skill set, macro analysis. Chia elaborated, "As the leader of the company, I must constantly learn new strategies and ideas to take the company to the next level. Not only do I have to consider the structure of the company, but also how we can evolve as a whole in line with the broader macro environment. If we had decided to close the fund and remain a small entity in the early 2000s, we would basically have been ignoring the growth potential in Asia and the macro landscape. Without progress, you fall behind. As die-hard bottom-up value investors, we focus on businesses. But at my level, I must also pay attention to top-down factors, such as the state and outlook of the economy, so that I can guide my team in asset and portfolio allocation. For example, if you know that the economy is softening, you need to increase your cash holdings or at least allocate your positions to more defensive sectors. You cannot simply focus on a company and ignore the surrounding environment. Although some would view him as a workaholic, Chia is a ferocious reader who never stops learning. In addition to reading, which is both a hobby and a means of relaxation, Chia, a practicing Buddhist, also meditates for about 40 minutes a day. Meditating not only allows him to unwind, but to set his mind free and to observe it from the inside, no doubt generating a few investment ideas. Chia believes that his success is partly due to simple luck. He happened to be in the right place at the right time when China began to open up its economy in December 1978, and Deng Xiaoping announced the country's open-door policy to promote market forces and a capitalist-inclined system. Then, in 1992, during his southern China tour, Deng pronounced that, "to get rich is glorious." Until his death in 1997, Deng was a strong advocate of the four modernizations, originally set forth in the 1960s to strengthen agriculture, industry, national defense, and science and technology. Marching forward with his team at Value Partners, Chia would add a fifth modernization, financial market modernization. He concluded, "China has gone through traumatic times, particularly in the 19th and 20th centuries. It was once considered the sick man of Asia. Although the country has recently exceeded our wildest expectations in terms of economic development, poverty eradication, and urbanization, in many respects its financial system remains in its infancy. In the years to come, China will develop a world-class financial industry, and that is where Value Partners and the Hong Kong people come in. We can help contribute to this fifth modernization. The rising wealth of the Chinese people makes them vulnerable to the financial pirates lurking out there. Our mission is to protect them by showing them the benefits of value investing." Chapter 13. The Making of a Value Investor. If you can keep your head when all about you are losing theirs and blaming it on you. If you can trust yourself when all men doubt you, but make allowance for their doubting too. If you can wait and not be tired by waiting. If you can meet with triumph and disaster and treat those impostors just the same. If you can talk with crowds and keep your virtue, or walk with kings, nor lose the common touch. If neither foes nor loving friends can hurt you. If all men count with you, but none too much, yours is the earth and everything that's in it, and, which is more, you'll be a man. Rudyard Kipling. I once asked Donald Keough, former president of Coca-Cola, what it takes to become a good leader. He replied that leaders come in different shapes and sizes, and that it is difficult to predict who will become a good one. Writing this book led me to believe that his comment is equally applicable to investing. Good investors come in different shapes and sizes, and there is no strict rule for identifying whose approach is best. Vinay Yeh of Value Partners in Hong Kong told me that many investors and investment books like to discuss the right investment style. Yet he believes it is more appropriate to first understand one's temperament and compatibility and then to choose a style. If you are a calm and patient person, then the value investing approach may be right for you, but if you are jumpy and aggressive, then a more trading-oriented style may be more suitable. Value investing is the focus of this book. Although I certainly do not rule out the possibility that other forms of investing may work, my encounters with 12 successful investors from around the world have convinced me that value investing works in a variety of countries, and that the philosophy underpinning it is as applicable today as it was when Benjamin Graham first began promoting it in the 1920s. During the course of researching and writing this book, I have made several observations about what it means, and what it takes, to be a value investor. This concluding chapter summarizes those observations. A humble portfolio construction. Humble is probably the best word to characterize the value investors featured in this book. Although humility is a virtue in its own right, in investing it translates into the margin of safety concept, which defends against uncertainty. Jean-Marie Evelard considers humility to be an essential requirement for investment success. The quality allows investors to be aware that they are far from being invincible, and that they can be wrong at times. I acknowledge the fact that I am uncertain about the future, so my priority is to avoid losing money, rather than to generate big returns. Evelard added that by assigning a margin of safety to investments, investors also need patience to wait for their ideas to play out. As Benjamin Graham said, in the short run, the market is a voting machine, but in the long run, it is a weighing machine. Humility not only encourages investors to look for a margin of safety, it also equips them with open minds. As Mark Mobius put it, with an open mind, you can accept that the world changes and that you must constantly learn new things to keep pace with it. Knowing that the world can be uncertain, most value investors featured in this book hold diversified portfolios. Generating superior investment performance is certainly an important aim, but safeguarding investors' assets and protecting them from losses is just as crucial. In that sense, diversification is a natural course of action. It is important to distinguish here the major difference between risk and uncertainty. Risk involves an unknown outcome that can be calculated or defined. For example, playing poker or investing in a stock can be risky, but people always know their odds and possible losses. Uncertainty, in contrast, implies an unknown outcome that cannot be calculated or identified. For example, no one has the perfect foresight to predict the duration of a market correction or an economic recession. Although the market is uncertain, investors can nevertheless calculate the risk of their investments quantitatively. In essence, value investors diversify their portfolios not because their investments are deemed risky, but because they acknowledge that the world is uncertain. William Brown believes that diversification is the only way to hedge against such an uncertainty. Some investors ask us why we would rather diversify into our 25th stock rather than put that money into our 10 best holdings. The truth is, we really aren't certain enough to say which are our 10 best, and so we would rather diversify. Warren Buffett is famous for running a concentrated portfolio. Although the late Walter Schloss agreed that it would be easier to keep a concentrated portfolio, he took a more cautious approach in his investment career. I see that there are many people trying to be like Warren, but they should take note that he is not only a good analyst, he is also a good judge of people and businesses. I know my limitations, so I'd rather invest in the way I am most comfortable with. Diversification is almost mandatory in emerging economies. Due to the economic and political instability in many countries, good businesses come and go, and even the most sophisticated investors can be cheated. Hong Kong-based Chia Cheng-hai told me, at first, I was proud to have a concentrated portfolio, but then I began to realize that there are simply too many crooks out there who sound and look convincing, but end up cheating us as shareholders. To a certain extent, diversification is a matter of degree. For example, London-based Anthony Nutt holds 100 to 110 stocks in his investment funds, but the top 10 holdings usually account for 40% of his portfolios. More selective with his investments, Singapore-based Ting Jik Lien holds roughly 30 stocks. He said that a more concentrated portfolio allows him to focus on surer bets and to devote more time and expertise to businesses that he knows well. Although Ting considers his portfolio holdings to be concentrated, 30 is still quite a high number of stocks to hold. In a random walk down Wall Street, Burton Malkiel notes that when a portfolio contains roughly 20 equally sized and well-diversified stocks, the total risk is reduced by roughly 70%. By spreading his holdings across the Asia-Pacific region, Teng has actually reduced the amount of country-, political-, and business-specific risk. The art of valuation. By reading finance books or taking investment valuation classes, anyone can come up with a fair valuation of an investment. The difficult part, then, lies in qualitative analysis because good value investors have the experience and know-how to predict the sustainability and durability of businesses. Spanish value investor Francisco Perums claims to use nothing more sophisticated than a calculator for investment analysis. He believes that it is not how sophisticated you are in your valuation model, but how well you know the business and how well you assess its competitive advantage. Similarly, Jean-Marie Evelard prefers simple investment measures because coming up with the intrinsic value of a business is a rough estimate, never a precise figure. If investors build sophisticated investment models that deduce the worth of a business down to the penny, they are probably trying too hard. The important point here is that intrinsic value is a numeric range that fluctuates over time. As the world changes, the critical factor is how investors qualitatively assess business and economic conditions and adjust their calculation accordingly. After he retired in 2006, Evelard taught value investing at Columbia University. He noticed that many students thought qualitative analysis involved pages of intensive writing and explanation. He explained, "What I tried to stress to them was that they needed to think hard and then list no more than 3 to 4 strengths and weaknesses of the business. Qualitative analysis sometimes goes beyond pure thinking. It requires action." The privilege of being an investment professional is that one is often able to meet company management. Thomas Kahn of Kahn Brothers told me, "We always ask ourselves what the catalysts are that can turn around undervalued companies. In determining these catalysts, I like to talk to management, assess their abilities and personalities, and understand their way of thinking so that we are on the same page." Constantly traveling to the most exotic countries to look for the next investment opportunity, Mark Mobius cautions that the financial numbers in emerging markets are not entirely trustworthy. You have to talk to company management, look into their eyes, and determine whether they are reliable. Reading for ideas. People often ask how successful value investors come up with their investment ideas. The simple answer is that they read a great deal. Francisco Perums argues that idea generation comes from having a consistent understanding of the world and synchronizing it with all of the information you have accumulated. It is a disciplined process because it does not happen by waking up one day and recklessly looking for ideas. For that matter, the desire to learn new subjects and the willingness to keep an open mind are critical. Thomas Kahn claims not to know any good investors who do not read. His father, Irving, is a good example. "My father has read thousands of books, and has a special interest in science. Because of his vast knowledge of the subject, he focuses on the future and rarely dwells on the past. He constantly looks forward to the technological breakthroughs and good things that will happen to mankind in the future. Irving Kahn himself reminisced about the early days when investors needed the right investment principles and mindset to generate investment ideas. Now, with the widespread use of the internet, finding good investment ideas has become easier. He told me, there were only a handful of industries in which to look for stocks in the old days. Now there are so many different types of businesses in so many different countries that investors can easily find something. Besides, the internet has made more information available. If you complain that you cannot find opportunities, then that means you either haven't looked hard enough or you haven't read broadly enough. In Asia, Chia Cheng-hai has dedicated himself to lifelong learning. He believes that good ideas are often self-generated. They come from paying attention to detail and patiently waiting for events to take place. Chia takes a creative approach by asking his investment team to visualize the future of their investments by imagining what journalists will write about them in a year's time. Some people attribute good investment ideas to pure luck, but they should pay heed to what the Roman philosopher Seneca wrote many years ago: luck is when preparation meets opportunity. More than just the fundamentals. There is a common perception that value investors focus purely on the fundamentals of businesses and disregard the broader economy. Although this may be the case in more developed economies, those who invest in emerging markets tend to keep an eye on macro factors. As Chia Cheng-hai said, you cannot simply focus on a company and ignore the surrounding environment. In Singapore, Teng Jik Lien believes that an understanding of Asian politics is particularly important. Because a change in political wind can lead to a drastic change in the economic direction of a region. Opportunities come and go quickly. As Asia's shorter economic cycle often leads to greater market volatility than that of mature economies, value investing should be applied in a more flexible manner than what Benjamin Graham or Warren Buffett has preached in the West. Teng cautioned, stocks can swing wildly. A long-term buy-and-hold strategy without due regard to market volatility can lead to underperformance. This is not to say that one should actively trade the market, but it is wise for investors to make a profit when the market is euphoric or a stock has reached its full valuation, and then to buy again when the market corrects. Japan's deflationary environment during the 1990s taught Shuhei Abe of the SPARX group the importance of taking a broader view and adapting to the situation at hand. Abe also suggests that investors must make adjustments to practice value investing in their respective countries. To cope with the lost decade in Japan, Abe came to the conclusion that knowing which investments are undervalued also means knowing which are overvalued. To benefit from both, he created a long-short investment strategy. With his new approach, even when Japan's economy continued to fall, Abe's investments thrived. He told me, to continue to bring Japanese market solutions to investors, we had to evolve. We had to build new trading skills that would allow us to fulfill clients' real needs, to preserve capital and generate positive returns. American and European value investors have also paid more attention to economic and political policies in recent years, especially since the fall of Lehman Brothers. Jean-Marie Evelard is unsure whether we are still in a post-World War II economic and financial landscape or if we have been more influenced by the financial crisis of 2008. He warns fellow value investors to be bottom-up all they want, but always keep an eye on the top-down. In the United Kingdom, Anthony Nutt remains a firm believer in the bottom-up approach. However, He agrees with Evelard that macroeconomic policies have had great impacts on global stock markets over the past few years. By looking at these policies with a top-down view, my job is also to identify long-term business trends. As long as we choose the right sector, we think that good companies with varying degrees of success can do well in different economic cycles. All of the value investors I interviewed have acquired in-depth industry and business knowledge over long periods. Although their investment rationale has always been based on the bottom-up approach, they grasp broad economic topics very well. They are not concerned about whether inflation is 2 or 2.5%, or whether the unemployment rate is 8 or 8.5%. But their overall macroeconomic framework and understanding complements their bottom-up investment analysis. Timing for an exit. The value investors in this book tend to have investment horizons of at least 3 to 5 years. When choosing the time to sell, they focus more heavily on investment valuation than on the investment's holding period. For Anthony Nutt, the most difficult aspect of investing is not determining whether a stock is cheap or expensive, but determining whether other investors are identifying the very same stock. If a stock is overlooked by the general market, it can stay undervalued for a while. To reduce any time-related anxiety, Nutt times his exit based on investment valuation. He sells his investments only when they have become fully valued, or their business conditions begin to deteriorate. Like Nutt, Irving and Thomas Kahn shun investment time frames. Some of their holdings have been in their portfolios for decades. They said that investors must avoid short-sightedness when holding value stocks because patience and discipline are paramount. The Kahns note that failure of a stock to rise within a few months or years does not necessarily mean that it is a non-performer. Value stocks often lag behind the general market for the majority of their holding period. When their true worth is finally recognized, investors are often surprised at their attractive annualized investment returns relative to the broader market. In value investing, there is such a thing as the value trap, when a stock that has been beaten down is mistaken for a value stock. Jean-Marie Evelard believes that if a stock is a real value deal, and if people still call it a trap, then it is their own problem. You can't say that it is a trap just because your holding period is mismatched with the time it takes for the stock to recover. If you have patience, and if your analysis is right, then the market will acknowledge the stock eventually. However, Evelard believes that there is a difference between a temporary unrealized capital loss and permanent capital impairment. The former requires patience because the value stock needs time to recover. The latter means the investor has misjudged the strengths and weaknesses of a business. When this happens, one should quickly cut the loss, learn from the mistake, and move on. In emerging markets, timing for an exit requires a contrarian mindset. Mark Mobius has a minimum holding period of 5 years, within which he welcomes market swings. Emerging markets are somewhat immature, and people get overly bullish and bearish all of the time. By focusing on value, we get in when everyone else is trying to get out. Also, our value discipline lets us compare different markets to see which ones are overpriced, so by the time everyone is trying to get in, we are getting out, he explained. Long-term investment performance comes from 2 returns, return on investments and the compounding effect of reinvestments. Many investors brag about their superior return on a particular investment. The trouble is, do they have more of these investments lined up? Vinay Yah in Hong Kong always considers reinvestment risk when he sells his holdings. Most people underprice and underanalyze the reinvestment risk. Even if you make a good investment and sell it, eventually you have to reinvest that money. The real distinction between a good and average investor is that the former constantly has good ideas about reinvesting capital to create a compounding effect. Superinvestor Walter Schloss, who focused more on the numbers than on the potential of businesses, always sold his holdings too early when they reached a reasonable price. Because he focused on the downside risk, he neglected the potential upside. In the end, he had to outwork his peers to come up with reinvestment ideas. Schloss commented, "Sometimes in life you cannot regret things that didn't work out or that could have worked out better. The challenge in life is knowing what's next." After all, my goal was to keep losses down, and if I could catch a few stocks going up, compound returns would work their magic. Although Schloss was too humble to admit it, even selling too soon generated a compound return of 16% per annum for over 46 years. Compared to the Standard & Poor 500's return of roughly 10% over the same period, investing with Schloss would have generated 10 times more money. Having the right temperament. My discussions with the 12 investors convinced me that being a value investor is highly dependent on character. Jean-Marie Evelard asked, "How come there are so few value investors out there?" His answer was that they had to accept lagging behind their peers and that they would suffer psychologically and financially in doing so. Knowing that there is no instant gratification in an investment, Vinay thinks that the value investing philosophy boils down to character. Value investing attracts conservative people who look for the downside risk of an investment first. He told me, "Value investing is the development of a sense of fairness because ultimately you are looking for a margin of safety, by starting off from a point of conservatism. By doing so it encourages prudence and guards against following the crowd." This school of thought helps develop the right temperament, which indirectly cultivates an investment process and strategy. William Brown believes that investors are naturally emotional and affected by the news, but value investors can still maintain their calm in face of opinions and comments from the media. Perhaps the secret is their intellectual framework for thinking objectively. All of these value investors believe that investing is half art and half science. Although we need the basics to calculate the value of an investment, the more important part is to think hard. As Thomas Kahn said, if the investment game were all about numbers, computer programs would be able to find the right stock all the time. The truth is that they cannot. As I learned when writing my last book, Behind the Berkshire Hathaway Curtain, Lessons from Warren Buffett's Top Business Leaders, an investment decision should always be based on clear facts and assumptions because a business can only be worth so much. As Buffett said, "Price is what you pay, value is what you get." A superior investment track record is not just about a year or two of outperformance. It is about surviving the market under various circumstances. Having the right investment model is important, but investing with honesty and integrity are more critical. The late Walter Schloss, who endured 18 economic recessions in his long life of 95 years, is a role model for every investor. Warren Buffett said of Schloss in a statement after his death in February 2012, "He had an extraordinary investment record, but even more important, he set an example for integrity in investment management." Walter never made a dime off of his investors unless they themselves made significant money. He charged no fixed fee at all and merely shared in their profits. His fiduciary sense was every bit the equal of his investment skills. William Brown said that Schloss was packed with integrity because he never came close to any unclean dealings, and his responsibility had always been to protect investors from losses. Brown said, Friends and clients may forgive you for the silly mistakes you make in the stock market, but never for a dishonest mistake. Always optimistic about the future and never allowing stress to get in his way. Schloss's dear friend Irving Kahn would argue that wealth with no health means nothing. At 106 years of age, Kahn thinks that the key ingredient to successful investing, not just for the value investor but for every investor, is to stay in motion, meet different people, be inspired, read a lot, and focus on the future. There is always something to do. You just need to look harder, be creative, and be a little flexible. All in all, investing should be fun and challenging, not stressful and worrying. In an uncertain world, the practice of value investing is really a way to maintain a peaceful mindset. By focusing on a margin of safety, thinking for the long term, and having patience, the goal is to achieve investment stability over time. In the process, investors may well achieve happiness and satisfaction in life. Benjamin Graham, the father of value investing, should have the last word. The investor's chief problem, and even his worst enemy, is likely to be himself. About the author. Ronald W. Chan is the founder of Chartwell Capital Limited, an investment management company based in Hong Kong. He is a frequent contributor to financial newspapers and magazines in the Asia-Pacific region, and is the author of Behind the Berkshire Hathaway Curtain, Lessons from Warren Buffett's Top Business Leaders. Chan received Bachelor of Science degrees in Finance and Accounting from the Stern School of Business at New York University. Thank you for watching our channel, The Learner's Library. Please like, subscribe, and comment.